Remember, this whole rally from the October lows has been predicated on this idea that the Fed was going to pause and start cutting rates fairly immediately, but the idea of any type of rate cut now has really been pushed off into later this year. Here's what you need to know before the bell. Got a lot of questions here over the last few days, in particular about bonds. Bonds have been under a little bit of pressure here, particularly since the Fed has started talking about needing to hike rates a little bit more. 10-year Treasury has been under a bit of pressure. Longer duration rates have been going up, about 3.9% right now. Still within, we're just been trading back and forth within this kind of range between 3.5% and 4% now. It's no big deal. But, we've been in a very long period of pressure on the longer duration end of bonds, right? So the 10-year, the 20-year, 30-year bonds been under pressure here because of what we saw with economic growth. Here's the key point. Interest rates are not controlled on the long end, are not controlled by the Federal Reserve. The Federal Reserve controls the short end of the yield curve. They control the 3-month, the 1-year, the 2-year bills. The long duration assets, the 10-year, the 20-year, the 30 years, those are driven by economic growth and inflation. Now, the reason that interest rates moved up over the last year or so in particular was because we had this massive monetary impulse into the economy that created inflation, a very strong surge in economic activity, and so interest rates in the longer end went up, and that's why mortgage rates went up. We had a lot of demand for houses, etc. All that's coming up. All that was pushing rates higher. Now the question you have to ask yourself, I'm getting a lot of emails about this. They're like, well, the Fed's hiking rates again. That means interest rates have to go up. No. Keep a watch on what's going on with the economy. If you're expecting a recession and expecting a slower economic environment because of higher rates, slower economy, and what's happening with inflation right now, inflation's coming down, those are what drive the long end of the curve. And when you start taking a look at a long-term chart of interest rates, bonds have never been, and interest rates in particular, have never been this depressed really ever since the beginning of this century. So now that's only going back 20 years, but going back 20 years, we've never been this oversold in terms of interest rates, and we're just about to trigger a monthly buy signal on bonds right now, and that would suggest slower economic growth and lower rates of inflation here over the next year. But in particular, every time that we've had these type of signals, these have been really good opportunities where we have seen a point in time where bond prices rose and yields fell, and that's exactly what you would expect with a slower economic environment, lowering inflation. And then, of course, ultimately, if you're betting on the Fed to start cutting rates, that's even suggestive even more that you're near a trough in bond prices, because as they start to cut rates, they're going to be cutting rates in response to either a recession or much slower economic growth. They're cutting rates to try to support economic stability. So as the Fed starts cutting rates, that's in response to a much weaker activity. That means yields will be falling, bond prices rising. And again, there's a lot of negative positioning in bonds, which will provide that eventual fuel for a rally in bonds as we get into really 2024. But again, this is a longer duration asset. This is going to require a period of time for inflation to really come down towards that 2% level, and of course, probably even less at this point. But also as economic growth begins to slow even more. And again, economic growth has been slowing, but we haven't got to that point in time where we're back towards a real recessionary concern. So again, that may not be this year. And the questions I get is like, well, interest rates are still going up. Yeah, we're still in this process. And if you're betting on a longer duration asset, this just takes more time. And so you've got to give this the time for economic growth and inflation to get to the point that bond prices and yields begin to respond in kind. And we're probably getting fairly close to that. But again, we'll keep a watch on this. But again, a lot of emails here lately. Just keep a watch on this. Watch economic growth and inflation, because that's going to be the driver for yields and bond prices as we get out into 2024. I'm your host, Lance Roberts, and that's what you need to know before the bell.